include the finance cost, the borrowing costs. So this standard is quite far-reaching, but the good news is that the scope was brought in right at the very end. So the exposure draft didn't have it, but right at the very end they brought in the scope exclusion to basically exclude items of mass production. So if you happen to be a manufacturer of tables and every table takes a month and every single table you turn out is exactly the same, then consequently you would not have to capitalise those borrowing costs in that. So the scope exclusion kind of like helps us out somewhat. So what costs do you include? Well, you include the directly attributable costs of producing or manufacturing the asset. So when you look at the asset, you would say it has cost us however much to produce it. There will be a borrowing cost as a result of having spent that money on that particular asset. So if the asset has cost us 1,000 units to produce, 1,000 currency units to produce, and we have borrowings of however much, then we will use the interest rate on those borrowings multiplied by the 1,000, and we will increase the cost of the asset as a result of that. Okay. So what we need to do really then is we need to start having a look at some numbers on this just to make sure that you are sort of comfortable. And what we have is we have two types of borrowings which are covered by the standard. The first one is specific borrowings. So if I have borrowed money specifically for the purpose of constructing this asset, okay, the amount to be capitalised is the actual borrowing costs minus any interest received from the temporary investment of those funds. Okay, so the amount capitalised is the actual borrowing costs incurred minus any interest received from the temporary investment of those funds. So, let's say for example I want to sort of build a building, and that building is going to cost 1 million to build. Okay, it's going to cost 1 million. As a result of that, I borrow 1 million. Okay, and I get the cash up front. However, because this is to do with the building, the terms of the arrangement are is that I'm only going to pay 20% up front and 80% on completion. So the company that is building this for me, they're charging me £1 million, and I'm only going to give them 200,000 up front, and I'm going to give them the other 800,000 at the end when the building is sort of ready for use. Okay. My interest cost, or my borrowing cost, let's just say is 10%, and I get interest income at say 2%. As we know, it's always more expensive to borrow money than it is to sort of lend money. So on my borrowings I get charged 10%, and on my investments I receive 2%. Okay. So the rules are: construction has to have commenced. Okay, so I can only capitalise the borrowing cost whilst construction is ongoing. Okay. So for construction to be ongoing, I would say my actual cost of borrowing. So let's just assume that the building's been going on now for the whole of this year. My borrowing cost is going to be 10% times by 1 million. Oops. Which is therefore 100,000. Okay? The fact that I've only spent 20% of that means that the other 80% of it, the other 800,000, has been invested and has been earning 2%. So interest income will be the 800,000 that I have not spent times by 2%, which is 16,000. Therefore the amount capitalised is going to be 84,000. Okay. So the 100,000 is basically not going as an interest expense in my profit and loss. The 16,000 interest income is not being shown as an income in my profit or loss. All I'm doing is I'm netting the two of them off, and I'm including 84,000 as part of the cost of that asset. So the ultimate cost of the asset will be 1,084,000, and I would depreciate that over the useful life of that asset. Okay, and I would just charge its depreciation. As I depreciate it, I don't need to separate out the interest element at all. The whole thing would just go through as normal depreciation expense. So the asset would be costing 1,084,000. Okay, the borrowings in the balance sheet would still say sort of like 1 million. Okay, because I've capitalised 84,000 of interest cost. So that is what you'd need to do for specific borrowings. But remember, you're only capitalising it whilst construction goes on. Oops. So if in the middle of this construction there is a dispute and all the workers down tools, okay, then you would have to sort of pause the capitalisation. My apologies if you can hear a bell in the background, they're testing the fire alarms, sorry about that. But whilst construction is ongoing, you must capitalise so those borrowing costs. If there is a break in construction for any reason, whether it's industrial dispute or otherwise, you stop capitalising the borrowing costs during that period. Okay? So that would be for specific borrowings. We now have to consider the issue of general borrowings. And if I'm absolutely honest with you, this is the nasty bit. Okay? With specific borrowings, it's very easy because you are specifically borrowing money for the purposes of constructing an asset. With general borrowings, you kind of have to look at it with a little bit more of a holistic view. For example, most businesses have got borrowings, whether it's loans, whether it's debentures, whether it's an overdraft even with the bank. Okay? So an awful lot of businesses would have a number of different sources of their borrowings. Let's say, for example, with this business we have an overdraft, okay, of 500,000, and that overdraft charges me 10%. I've got a bank loan of 2 million, and that only charges me 5%. Okay. What we have to do is we have to say, right, I need to capitalise my borrowing costs. And what I have to use is I have to use a weighted average cost of borrowing. Okay? So I need to calculate a weighted average cost of borrowing. Okay? So my weighted average cost of borrowing, well, I've got 500,000 at 10%, so that gives me interest of 50,000, and I've got 2 million at 5%. Which gives me 100,000. So on a total of 2.5 million of borrowings, I'm suffering 150,000 of interest. Okay. Therefore, to work that out, if 150 divided by 2,500,000, that gives me an average of 6%. Okay. So what we're saying is I have borrowings here of 500,000 at 10%, 2 million at 5%. This together gives me a weighted average cost of borrowing of 6%. So I'm paying interest of 150,000 on borrowings totaling 2.5 million. I would now use that 6% to capitalise my borrowings. So if I have an asset and the average cost in the period is 1 million. So in other words, I built this asset during the whole of this year. Obviously at start it hadn't cost me anything, but by the end of the year it's now cost me 2 million. So the average balance of that asset for the whole year is 1 million. I would therefore capitalise 1 million times by 6%. So I would actually include, as part of that asset, borrowing costs of 60,000. So I'd include 60,000 as part of the cost of the asset. Okay, so we have specific borrowings. If you have specific borrowings, you use the actual borrowing cost minus any interest income from the temporary investment of those funds. If you have general borrowings, you capitalise at a weighted average cost of borrowing, yeah, and you apply that to the weighted average carrying value of the assets concerned. But remember, they have to be qualifying assets, and you can only capitalise the borrowings during periods of construction. So, as I said, if construction ceases for any reason, you would no longer be capitalising the borrowing cost during that period of construction, of non-construction rather, sorry. Okay, so we capitalise once construction begins, we stop capitalising once construction ceases, and we would stop capitalising during periods in the middle where there is a break in the level of construction. Okay. Now, just to clarify that, if you just look at illustration 4, please, on page 108. Okay, so page 108, illustration 4 deals with this suspension of capitalisation. Okay. The following events take place. An entity buys some land on the 1st of December. Planning permission is obtained on the 31st of January. Payment for the land is deferred until the 1st of February. The entity takes out a loan to cover the cost of the land and the construction of the building on the 1st of February. Due to adverse weather conditions, there is a delay in starting the building work for 6 weeks, and work does not commence until the 15th of March. Okay. So the key dates for consideration. First of all, 1st of February is when construction commences. Borrowing costs are being incurred from the 1st of February as well. Okay. Although work was being undertaken on planning permission during December and January, there actually weren't any borrowing costs being incurred during that period, so we definitely can't capitalise anything until we've borrowed the money and construction has commenced. During the 6-week inactive period, okay, we will not be capitalising those borrowing costs. So when it says they, due to adverse weather conditions, they delayed the building work for 6 weeks, then we do not capitalise any interest whatsoever for that 6-week period. Okay? So in reality, in this situation, you would start capitalising your borrowing costs from the 15th of March. Okay. Now, just to finish this off, some fine little sort of fiddly bits, if you like, on borrowing costs. If you have general borrowings, and you also take out specific borrowings for a particular asset, then all you do is, when you're working out your weighted average cost of borrowings, you separate out the two elements. Okay? So if we take sort of the example, or almost the example that I used earlier, okay? So what I'm basically saying is I have 500,000 at 10% overdraft. I have a loan of 2 million at 5%, and let's say I've issued some debentures. I've issued 1 million of those at 4%. But the reason why I've issued those debentures is to finance a particular building project. So those ones are specific to a project. Okay. So if the reason I've issued the debentures are specifically for the purposes of undertaking a particular project, then what I would have to do is I would capitalise the 40,000 on the specific project, and then use a weighted average on general borrowings for anything else. So I would separate out the specific project and I would capitalise the specific borrowings on the specific project, and then I would calculate my weighted average excluding those specific borrowings for the purposes of capitalising borrowing costs on anywhere else. Okay. So, good news. That's basically the end of sort of borrowing costs, which kind of brings us to the end of sort of like the teaching component of today. All that remains really is for me to open up the floor to yourselves again if you've got any questions on sort of borrowing costs, or in fact sort of, you know, we've got a little bit of time, anything that has arisen from the rest of today. Once we've gone through some questions, I'll then just spend 5 minutes talking about what's going to be covered in session 2. So has anybody got any questions at all, please?
Yes, I have questions. On this example that you just raised, it's the same currency as, say, for example, you use the same currency as for the building, something like that. What if it is the foreign currency borrowing? How are you going to treat the foreign exchange? Which is the interest rate different?
Right. What you would have to do is you would have to factor in the different currencies. So if you had, for example, a large multinational group that had a centralised treasury function, you would take into account all of the borrowing costs of the whole group, which, like you say, would be in different currencies. However, what you would need to do is you would need to sort of adjust the interest rates for the purposes of sort of like the different currencies. So you have interest rate parity in pretty much everywhere around the world. So you would factor interest rate parities in to remove anomalies that may occur. So you would actually take into account the foreign exchange rates in dealing with the different currencies and different interest costs.
Okay, I have a question from the Philippines.
Yes, sure. Yeah.
My question is on the weighted average cost of capital or cost of borrowing. When we do that and we're using outstanding loan, is the outstanding loan beginning balance, ending balance, or weighted average for the year?
Yeah, this is where it can get very complicated, because you're exactly right. In my example, I simplified it by just assuming we had the same level of borrowings for the whole year. In reality, what you would need to do is you would adjust it at each month and have like an average borrowings for that period. But the way you would do it is, if it's, for example, an overdraft, you would say we had a balance of 1,000 for January at 7%, 3,000 for February at 7%, 4,000 in March at 6%, etc. And so the calculations on this can get really quite messy. For the purposes of the assessment and the certificate, they will be relatively simple. But this is really one of the real-world implications that actually gets quite messy, because you will need to do a weighted average. Now, weighted averages can be as simple or as complicated as you would like. The standard only requires you to use a weighted average. So I would suggest do it on a monthly basis rather than a daily basis or weekly basis. Okay, so weighted average level of overdraft, weighted average borrowing cost on that overdraft for the year, multiply the two together, and that would help you identify your weighted average cost of borrowings. But that's an excellent question. It's a very, very good point. Yeah.
As a follow-through question, what if that is a foreign loan and it has a forex gain or loss component? Can the forex gain or loss component of the borrowing cost be capitalized as well?
No, it's a very good question. Again, it actually ties into the previous question that we had, sort of from, I can't remember which location it was, but they were asking about the implications of foreign borrowings. In this situation here, we're saying we have the sort of weighted average borrowing costs. What if one of those loans had foreign exchange gains and losses within it? You would actually take into account the different currencies when arriving at the levels of interest rate. So theoretically, and unfortunately this is a theoretical area, but in a theoretical world, the borrowing costs in one country and the borrowing costs in another country should actually be fairly equal because of exchange rate mechanisms. So you shouldn't be able to make much money by borrowing money in one country, converting it to another currency and then investing it in that country. So the idea being is you would take into account fluctuations in exchange rates in the levels of borrowing costs. So gains and losses on retranslation of these loans shouldn't play a part in the actual cost of borrowings, because you'd be just using the straight interest rates. Yeah, because you are utilising sort of like interest rates. The problem really arises if you have centralised treasury functions and things. And like I said, the calculations can get a little bit messy on that. But yeah, a very valid point, and that I think is one of the real-world complexities of IS23, that until it really comes in and we start seeing a little bit of best practice, there's no real indication of exactly how businesses are going to do this. Personally, I would say that it doesn't have to be exactly correct. You're using weighted averages anyway, so therefore my view would be, cost-benefit analysis. If the cost of producing the information massively outweighs the benefit, then there's very little point in doing it. And again, guidance from auditors on this would almost certainly be required for most companies in the real world as to what level of detail the auditors want them to go. Okay, does that answer your question?
Yeah, okay, thank you.
Can I
Thank you.
make a follow-up? Still in the Philippines.
Yeah. Certainly.
Will you? Am I on?
Yes.
Yeah. Can you include the cost of processing the loans in the borrowing cost to be capitalized?
Underwriting fees.
Yeah, that one's again a very interesting question, because we're going to be picking it up in financial instruments. With financial instruments, any kind of costs of establishing those borrowings will be reflected in sort of the actual balance that is recognised, and therefore you get an effective interest charge to cover any additional issue costs. So if you sort of borrow some money and there is an arrangement fee of say 5%, the actual amount you treat it as having borrowed is increased by the 5% charge. So therefore you would utilise an effective interest rate, which in turn is taking into account any sort of transaction costs of organising those borrowings. We'll see a lot more on effective interest when we move on to financial instruments in a later session. But yes, fundamentally at this level, you would be recognising those arrangement fees as part of your borrowing costs, and therefore that would be reflected in the effective interest rate on those borrowings. So yeah, another excellent question, by the way. Thank you. Okay, are there any more questions from anywhere?
I have a question on the borrowing cost again. The expenses related to derivative instruments, can they be included in the borrowing cost or not?
Sorry, could you repeat the question, please? I missed the very first part of it.
The expenses arising from derivative transactions, for example, if you have swap, and then can be included in the borrowing cost? The premium from the swap, something.
Yeah, and in that situation you wouldn't actually be able to sort of include that, because that would be a separate financial instrument that would be being sort of valued. So you'd only be able to include the actual borrowing costs. Yeah, and again we'll see more on swaps and hedging when we move on to financial instruments. But under the process of a swap, you have basically kind of like three components. You have the original loan with your bank, you have the terms and arrangements of the swap, and you have the transactions as the kind of trading out of that swap. The actual borrowing costs that you're incurring are the effective borrowing costs sort of ultimately, but the change in value of the swap itself would not be reflected within those borrowing costs. The end position would be, because if you're swapping variable interest rate loan for fixed interest rate loan, then the amount of borrowing cost that you would actually be capitalising would be based on the fixed cost, as in the fixed amount of interest. So the terms of the swap would be reflected, but the actual valuation of the swap contract wouldn't be reflected in those borrowing costs. Again, we'll see more on hedging and how we go through the transactions on that when we move on to financial instruments in a later session. Okay. Does that answer your question?
Yeah, thank you, Gavin. Yeah, thank you.
Excellent. Okay, do we have any other questions before I move on to introducing session 2?
I have another general question actually. From the materials that
sure.
The materials that are provided to us, is it sufficient
Yes.
to learn from it, or do we have to refer to the original text, which would be more complicated and more comprehensive for the purpose of the
right?
exam?
The materials that you have in front of you are fairly comprehensive for the purposes of achieving the certificate. They don't go into as much detail, obviously, as the standards do. You can tell that just by the thickness of the material. There's obviously a lot more in the standards. For the purposes of the certificate, I would say, yes, the materials that you have in front of you would be adequate. For the purposes of personal development and being able to train other people, I would suggest that you need sort of like a little bit more depth to your knowledge. But certainly the information you have in front of you now is more than adequate for getting you to the point where you would be proficient in IFRS. Like I say, from a training perspective, I mean, if you consider some of the questions that we've been asked, I've been asked today, they've gone into quite considerable amounts of detail, more than the information that is in the actual materials you have in front of you. So I would say that you can use the materials as a starting point, but that's probably in reality 75 to 80% of what I would suggest you need to do in order to be able to train others and also to sort of fully round your understanding. But it's certainly a very, very substantial sort of the way towards getting a fuller understanding of IFRS. But like I say, certainly from the information and things that we're covering, I wouldn't be expecting or assuming that you'd read around the subjects anymore. But as I said, with the IAS 18 information on revenue recognition, it would be a good idea to have a look through that appendix because it can help clarify your understanding in some way. So I would kind of hope that you'd be reading around the subject as well as going through the material in more detail than we are doing.
Okay, I wanted to add here, I would like to suggest to all the participants to have access to full IFRS book.
Yes.
So that they can, while learning using these learning materials, so that they can look for complicated issues and ask the instructors to help in understanding those complicated issues. And I would like to request you again and again to take advantage of tutor support provided from London in between the GDLN sessions. I think home learning and communicating with the tutors will be most useful for learning these IFRS materials, for preparing yourselves to go for providing training to others in your own countries. Thank you.
I couldn't agree more. That's sort of a very, very sort of a worthwhile point. As I was just saying to a gentleman in the Philippines, I would anticipate you needing to do some background reading to be able to deliver training to other people. You know, what Zubida said is exactly right. You know, access to the full standards is very beneficial, and you have got the resource of myself and sort of like other members of my team who will be kind of like online, sort of literally at sort of in 10 minutes from now. They'll be going online and they'll be able to answer sort of any questions you don't. I'll be online myself as soon as I've sort of like packed up here. But there'll be 3 of us that will be sitting there able to sort of answer your questions. Every answer that you get will be signed off by Gavin, because that's sort of myself, and it may sort of vary the people on the other end of the line. But there is you know, a team of people here who are kind of willing, able and wanting to sort of help you. And if it gets to the point where your issue is very complicated and doesn't really work in the context of email, you know, we have got the capacity to always just pick up the phone and we can do that, you know, sort of via email. We can give you contact details should you need to have a conversation with any of us sort of at a sort of a slightly later date. But like I say, predominantly you'll find that the email is the best to deal with kind of like time differences, etc. What I just want to do now is just kind of introduce what we're going to be covering on the next session, which is kind of working its way through the chapters that we've already seen. So in the next session I'll be covering assets held for sale and discontinued operations, which in itself is another area where there's quite a significant ability to manipulate financial information. It's a slightly more complex area. We've kind of started off on the course, if you like, with some of the more straightforward topics, just so that everybody involved can get used to the delivery method, can get used to navigating a way around the material, and if anything else, understand my sort of accent, and gives you the opportunity as well to raise any points. So for example, if you couldn't read my handwriting, which I'm sure some of you struggled with, because I struggle with it sometimes, then by all means let me know and I will try to sort of like, you know, slow down with my writing. If it was too small, then again, if you can drop me an email, then I can modify it ready for the next session when we're moving into some more complex areas. So we'll be covering assets held for sale, we'll be covering investment properties, we'll be covering intangible assets, impairment, sort of, and agriculture. Okay, sort of in IAS 41 in terms of how to deal with sort of farming and agricultural businesses. So that'll be what's covered in the first day of the next session. Okay, so obviously any questions that you have already got on those topics we can perhaps deal with. If you send me some emails about those topics and I know that we're going to be covering it, then I may just reply to you saying this will be covered in the next session and give you a very sort of an overview answer. But by all means read ahead in your notes. That makes life a little bit easier from my point of view because it means that you will already have questions in mind. So like I say, my request to you would be sort of over the next couple of hours if possible. If you do have any feedback on the session, anything you would prefer me to do differently, sort of anything that you would sort of particularly enjoyed me doing, then by all means let us know because we can make sure that we build that into future sessions. And I'm sure that sort of the World Bank representatives would be more than appreciative of your comments on how you're finding the session so far. So unless there's any more questions or comments from any of your sort of any of the other rooms, I'll basically sign off from now, and I look forward to hearing from you in sort of the next couple of hours, and then again in July when we're back for the second session, and also the webinar that we'll be doing in sort of the start of July. So thank you very much. Well done. You've had a tough old 4 hours or so. I hope you've got as much out of it as I have, and I look forward to seeing you again and hearing from you soon. Thank you very much.
Thank you very much, and we look forward to our meeting again using this GDLN facility. Thanks a lot.
Absolutely. Thank you.
Thank you.
Well, we have formally concluded, but if anybody has any question to me, you can ask me.
Sorry. Sao về chưa? Có chào ai không? Có chào ai không? Anh Lâm anh chưa?
Hôm nay tới đồng chí Trung Biên nhé.
Rồi hôm nào mấy anh em đi, còn ấy mà. Nào có bộ cái đấy. Anh đi nhờ hả? Ông thì dậy được cái chứ nhỉ? Về văn phòng. Về không, đến phòng.